Hi, this is Derek Hodges of Pointe Wealth Management. An interest rate hike is likely to happen by the end of the year because the economy is strengthening, but the slow pace of growth since the Great Recession years could be a new normal. That was the news coming out of Jackson Hole, Wyoming in late August at an economic symposium hosted annually by Kansas City Federal Reserve Bank. In her keynote address, Janet Yellen, chair of the Federal Reserve Board of Governors, offered good and bad news. The good news is the U.S. economy is continuing to expand. The bad news is that the business investment remains soft, and exports are weak because of the strength of the U.S. dollar versus foreign currencies. Yellen said the faster GDP growth experienced by the United States since World War II may not return anytime soon. Yellen cited a number of reasons for this, including slower growth in the working age population in many countries, smaller productivity gains in advanced economies, and possibly fewer attractive capital projects in which to invest worldwide. Yellen's speech may have been fascinating to economic policy wonks, but it did not have much of an effect on the financial markets. That's because she was predicting the long-term future, which she admitted no one knows. But here is what we do know. The consensus forecast of 70 economists surveyed in early August by the Wall Street Journal is for considerable strengthening in the months immediately ahead. However, over the longer term, as Yellen mentioned, growth of the U.S. population is putting a cap on growth of the U.S. labor force. While it's reasonable to expect strong growth in the months immediately ahead, it is not reasonable to assume the U.S. economy is capable of sustaining a quarterly growth rate of more than 2.3% for long stretches of time in the years ahead. In her speech, Ms. Yellen said the Fed will decide on the timing of a rate hike in the weeks ahead. If the data in early September signals strength, an interest rate hike could come as early as mid-September, when the nation's top central bankers next meet. But if the data signals weakness, the Fed may put off a rate hike until November or December. Despite Yellen's cautious comments, the long economic expansion continues, and July's new home sales were very strong, surging 31% over July 2016. New home construction is on an upswing and happens to be a major driver of growth in the U.S. economy. Ms. Yellen's speech didn't impress Wall Street, and the Standard & Poor's 500 slipped that day by 0.2%. That's because, as Ms. Yellen has always communicated the Fed's economic expectations so explicitly, the markets are never surprised by what she says. Stock prices remain near an all-time high. Bad news or an emotional shift in sentiment could cause a drop in stock prices at any time, but economic fundamentals point to growth, and that is reassuring to long-term investors. Please contact us with any questions or to set up a meeting, and do not hesitate to share this video with people who might benefit from our work.